So this sovereign debt bubble you're talking about, and you say it's bursting, and then you say they will print to keep it going. But I've had a few conversations with Lynn Alden, who I know you know well, and I feel like we're yo-yoing towards possibly even much higher inflation. What's your read on the sovereign debt bubble? How do you think it's escaped, and can it even be escaped?
Well, it can't be escaped. It can only be worked through. And there's only two ways to work through it once the debt levels get high enough. And that is you default slash restructure, or you inflate it away. You basically cap yields. Central bank buys the debt, caps yields, lets inflation go. And you inflate it away so your debt to GDP is back down to a low enough level. So basically you write down, you bondholders lose money on a nominal basis or on a real basis, basically, are the two ways to work through it. I guess there's a third way, which is energy productivity miracle, right? You can get out of it. In fact, the UK got out of one, I want to say it was after the Napoleonic Wars. So like 1850-ish, you had a productivity boom. You just happened to discover fossil fuels and commercialize them. And you had this massive, unprecedented historical boom in productivity that actually allowed the UK to get out of, to earn its way out of without really having to repress, without having to go off the gold standard. So it is possible, but you're talking about sort of, because the debt levels as high as they are, the commercialization of nuclear fusion on a compressed time scale type of productivity enhancement. So if you say we're not going to get this productivity enhancement, and who knows, maybe AI can help with that too, I don't know. Let's set that aside. If you set that aside, you either have to restructure or default on the debt, or you have to print the money to keep the debt nominally money good, but declining on a real basis to basically inflate it away.
And is the print the most popular option because a traditional default is much more damaging to the currency? Is it that when you print it away and there's a nominal loss to the bondholders, is that a more subtle way of hiding it?
Yeah, it's a more subtle way of hiding it. It's a more subtle way of hiding it. These days, when you talk about a lot of this debt being the underlying collateral of a lot of other assets, it almost becomes impossible to default on it, right? You hear all the time people say, well, treasuries are the collateral, and they are. That basically precludes the let it default option, which is actually really helpful from an analytical standpoint, right? Because we know where we are in the debt cycle. We know where we are with energy. And so then it comes down to these sort of key points when there is tension in the market, when there's volatility in treasury. Okay, we're coming to a point. They either have to let the debt default or they have to print. The chance that they're going to let it default is like zero. So then you can sort of scale your positioning and make your decisions based on that. And so I think politically, not just politically, it's always been easier, but practically speaking, from the actual underlying structure of the markets now, there's just no chance they can let it default, really. I mean, I can't say that there's no chance, but the chance is so de minimis as to be, I think, meaningless.
So do you think we're at risk of going through a decade of inflationary issues? It's something Lynn has talked about. She said to me, the story of the next decade is going to be inflation.
Absolutely. I think we are going through, and it really, the length of time is somewhat dependent on the rate of inflation and the ability to keep the population docile, tricked, for lack of a better word, about what the actual rate of inflation is. But ultimately, back in 2021, April 2021, I would say, we did a report for clients, and we looked at we said, okay, the last time debt to GDP in America was as high as it is after COVID was after World War II. And what we did was pretty straightforward. We capped yields at 2.5%, the 10-year, the Fed did, with yield curve control. And they let real rates go to negative. I think in the United States, I think they went to negative 13%. So basically your inflation rate was 13 points over the yield on whatever they were using, whether it was the front end of the curve or the back end of the curve, doesn't really matter much. It's a pretty flat curve. And the point is, from 45 to 51, U.S. debt to GDP went from 110% down to 55%. And then they did this thing called the Treasury-Fed Accord, where basically at that point they said, okay, now we're going to go back to being separate entities. The Fed's independent again. They're going to set policy based on what's best for the currency, not what's best for the government, and away we go. So we said, let's use that analog for now. We're at 130% debt to GDP as of April 2021. Our view was that they needed to get that number to 70 to 80% debt to GDP, because that was sort of, in my view, the last time the Fed was able to run a pseudo-normal Fed tightening cycle without really blowing something up remarkably fast. And so we said, okay, we need to take debt to GDP down by 50 to 60 percentage points. And let's say they do it over 5 years like they did after World War II. What would that entail, holding everything else constant in this relatively simple model? And what we found was that you needed 4 to 5 years of, call it 12 to 18% annual inflation just to get it there. So that implies two things. Number one, that level of money printing. Number two, that level of keeping the population, keeping the bond market still, right? Basically, you're holding the bond market down and euthanizing. You're putting the bond market to sleep. You're killing the bond market in real terms. And there's a number of reasons why, from a capital controls perspective in particular, that was much easier to do from 45 to 51 than it would be to do now. And so when you lay it out that way, it gives you two conclusions. Number one, inflation's the way out, and that gives you a sense of scale of the amount of inflation for the period of time that would be needed. But then number two, it highlights the difficulty of actually doing that, and the extremity of the policies that would have to be put in place to make that happen. And so where you go with that is some people say, well, we can just do 5% negative real rates for 5 years. No, you can't do it 5 years. Like -5 needs to be like 20 years. 15 years. And you say, okay, well, can we do it faster? That's probably what this conclusion tells you, right? Is it's going to be a surprise. It's not going to be 12 to 18% inflation for 5 years. It's going to be the Israeli situation in the early 80s, which is 100 to 300% inflation for 2 to 3 years, and voila, you're done. And I increasingly think that's where this is all heading toward, where they're just going to have to compress it. They're going to have to do sort of a real short-term, basically reset. Jack up the monetary basis, let inflation absolutely rip for a bit, because otherwise you can't, without capital controls, you can't screw the bond market in real terms for very long before you lose control of it. And so you kind of get to the same spot either way, right? Like you can't sit there and go, we're going to take 10% of your money, Mr. Bond Market, for 5 years. It doesn't work that way. They will instantly make that adjustment if they get the sense that's how it's going to go. So that it becomes self-referential.
So hold on. So you're saying perhaps in the US, even in UK and Europe, we could see 100 to 300% inflation?
Please don't make that the title of this one.
No, I won't. But Luke Gromen says,
right? Exactly. Yeah.
But are you saying that's the risk? That's a potential.
Absolutely, it's a risk. Yeah, it's absolutely a risk. And it's one of these things where people say, oh, if we had that kind of inflation, there's gonna be zombies. All you're gonna need is shotguns and spam, and it's an apocalypse. And you kind of go, Israel did it for 3 years. And, you can call up a guy named Stan Fisher, who was a former Fed vice chair. He wrote one of the authoritative papers on how to manage the process. And he was a Fed vice chair as recently as 2017, 2018. He wrote a BlackRock white paper in 2019 about how to inflate your way out of the next crisis. You cap yields, you let inflation rip. With the head of the Swiss National Bank and a former head of the Swiss National Bank and a Bank of Canada governor. So the point is that it happened in Israel. Israel is not the United States, obviously for a number of different reasons, from a size and from a economic complexity dynamic. But from a standpoint of a first world nation where they did it for 2-3 years, and like, pretty nice place to go visit. It's a nice place to, it's like the world didn't end. Bondholders got screwed for 3 years, and then you move on. And we are getting to that point of the movie where bondholders get screwed on a real basis in a short period of time, and we move on. And that, to me, yeah, I think it's possible, and I think it's important to say that the longer they delay getting to the inflating it away part, the more likely that becomes. So in other words, if we go back to 2021, I wrote that piece. I said, it looked like they were doing what they said they were going to do in 2019, which is, cap yields, let the debt go, or let the inflation go, get debt to GDP back down. It looked like they were doing what they did post-World War II. And then all of a sudden, 2022, here in the States in particular, it became a political problem. It was an election year, inflation, no one cared about COVID anymore. It was all about inflation. And so suddenly it started to become problematic, and they started fighting it, which is on one hand fine, but you once the debt is there, once the deficits are there, you don't have the option of like, well, I'm going to fight inflation now. No, your options are inflate it away or default. And the more you try to fight the inflation was the only thing keeping the government solvent. It's the only thing keeping tax receipts above where they needed to be to prevent really a debt death spiral in the Western world. And so when you fight the inflation, what you're really doing is increasing the strains so that the only outcome then becomes, the only possible way to get out of it at some point becomes 100% inflation for 2 years, for 3 years. That the more you, right, it's like, the more you delay, you're sick, you delay, you get to a certain point, and it's like, okay, well, if you have gangrene in your toes and you trade it early, great. But if you wait too long, at some point, the only thing to do is chop off your leg. And they keep delaying because of politics.
So I'm curious, when that happened in Israel, what happened to the markets? Because I would assume that a lot of the money kind of fled the country. But if that happened in somewhere like the US, where that money can't flee the country, like what happens in the markets in that situation?
If you look at the Israeli stock market, it was like,
really,
it looked like the Venezuelan Argentinian stock market, which is up in local terms. I don't know if they had capital controls on at that time. I should be more well versed in that. If we look at it today through this lens, then all of a sudden, when you start hearing things like Operation Choke Point 2.0, that starts to look, to me, Operation Choke Point 2.0, there's a political angle, which I'm not in favor of them doing that, but I don't want to talk politics. But as I just put on my, objective historical hat, it starts to look like, look, if I was in charge of the U.S. economic policy and they came and they said, Luke, we're going to have to inflate 100% a year for 2 years, where we tried to inflate a little, inflation got a political problem, then we went the other way, now we're having these treasury market problems, we're going to have to inflate it. But we can't allow, we can't put in capital controls, but we also want to control things in a way so that we don't look too bad, right? We don't want things going up that make us look bad. So if the stock market goes up a ton, there's not going to be any Americans going, oh, you guys are terrible. The stock market's up 100% a year for 3 years. Like the people will love that. They won't ask a lot of questions. If Bitcoin goes up 500% a year for 3 years, or if gold goes up 200% a year for 3 years, there starts to be more questions. So when I think about where they are, when I think about this framework of they need to inflate away, and by delaying the inflating away as much as they already have, they're increasing the odds they need to do a really compressed period. And then I look at Operation Choke Point 2.0 of, gosh, it sure looks like they're trying to chain the theater doors before they light the joint on fire. To me, I think there might be some informational value about where they are starting to see the inevitability of where policy is going to have to go, which is a compressed period of high rates of inflation. And I don't know if that's 100 or if that's 20 or, again, for me, 100 a year is still a tail risk, but that tail has gotten meaningfully fatter over the last 2-3 years. for me, choke point 2.0 within this starts to look like a capital control of an asset class that you would not want, that certain elements of the government would not want going up as a result of what they're doing.